what I'll do is to improve the audio. I will just keep my video on mute. I will keep my video off, which will also help in the audio. So with that, I will just start off. And as we just discussed, social security is an emerging area, both from a regulatory perspective as well as from an income tax perspective. And in this session, we have a bit of a mixed bag. So let me, before we deep dive into the session, let me just give you a brief idea of what we'll be covering. And what we'll be covering is broadly to talk you through some of the key amendments which have been made by Finance Act 2020 as well as Finance Act 2021. Now that's a key area of focus, clearly. And in addition to that, there have been some historical issues around PF which have not been addressed so far. We'll be trying to address those. And then most critically, as chartered accountants, taxation and auditing and accounting is our focus. Labor law perhaps is not so much of a focus. So we'll be talking you through some of the aspects of labor law, most notably PF law, both on the international worker space and as Sachin also mentioned, what is it for us once the new labor codes become effective? So that is broadly what the agenda is of today's session. Clearly, with the roughly 1 hour and 45 minutes, we can't cover everything of everything, but we'll try and cover a broad gamut of aspects and give you the needed perspective. So with that, let me start off now. The word social security. What exactly is social security? Okay. Now in India, we really don't have anything called as social security. Now you may be surprised. What about Provident Fund? What about gratuity? What about NPS? Isn't it social security? Well, very strictly, it is nothing but your own money that comes back to you after a certain period of time. Okay. If you talk about the developed countries, if you talk of Europe, US, Australia, Singapore, that's where you really have social security. Why? Because as everything the government takes care of, right from your medical emergency, if you're unemployed, old age pension, or if there is any let's say demise in your family, everything is covered by the government. That is what we would like to go as a country, but that is where we are not. So what we have is really our own money coming back to us. So that is social security in the Indian context. Earlier, many decades ago, it was only PF, and there was that small element of pension which the EPFO used to give us. Now you have a few more instruments. You have NPS, you have superannuation, then gratuity also has become, with the increase in salaries, that's also a sum that many employees look forward to receiving as a part of their terminal dues. So clearly, India is moving in the right direction, and with the labor codes, hopefully, after they come into place and after the whole system consolidates, hopefully we will have a real social security in place. Okay. So now what we'll do is, before we jump into the amendments, made by the Income Tax Act, and we'll be focusing more on the employee side of things, not so much the corporate tax side of things. Though Ketan Bhai did touch upon the corporate tax disallowance, but we won't really be going into that because there's so much to cover for us. So before we get into what are the amendments made by Finance Act 2020 and Finance Act 2021, and how does it really pan out and play out, before we get into that, let's just take you through some of the aspects of taxation of Provident Fund, NPS, superannuation, gratuity, just as a refresher, and also to highlight a very interesting issue in Provident Fund that probably has gone unnoticed for many decades. Okay, so this is how we will do it. Now, I will just request my colleagues to move over to the next slide, please. Yeah. Yeah, so can we go over to the next slide? Yes. Now, contribution to Provident Fund. Okay. Again, as I just mentioned, please pardon me if this sounds like a repetition. The objective of this session is also to bring in the flavor of the respective legislations, which is, say, Provident Fund, just to take an example, so that we have a well-rounded perspective. We are all experts on tax, but then, it's the other perspective that, it was felt that it was important to talk about that. And that is how this session got conceived. So with that, as you can see on your slide, let me invite your attention to the first bullet. What is Provident Fund? We all know that 1952 law, okay, which governs Provident Fund. What is Provident Fund to be contributed on? Well, in the industry, the common perception has been PF applies only on basic salary. But no, that is not how it is. If we go through the law, it applies on all components, dearness allowance. But of course, there are exceptions. House rent allowance is excluded, overtime is excluded, bonus commission is excluded. But largely, all components are included. And, if this packet, which is called as monthly pay, exceeds 15,000, then employers have you can say a choice to restrict PF on a base of 15,000. Okay, so that is how broadly the law is. But again, members will agree that the erstwhile section 271 1C in the Income Tax Act was probably the most litigated section over many decades, right? Similarly, and strangely, this particular section of what are the salary components on which PF applies has been, litigated right since the 1960s. And only thing is that there wasn't much interest in the professional world, except in March of 2019, when or was it end of February, early March, when the Supreme Court ruling in Vivekananda Vidya Mandir's case came out, and suddenly everyone began to talk about this. Okay, so let me also give you the perspective that when we talk to our clients, we realize, and I don't want to take any names, but the largest corporates, what we saw is they were defaulting on PF, especially where the salary or the monthly pay was less than 15,000. If employers needed to aggregate all components for the purpose of PF, they were not doing so. Okay, and what we observed is, it is just that this particular ruling made them think. And let me tell you, a lot of companies prospectively, that is post March of 2019, changed their practices and began contributing to PF on all the components on which PF applies. And that was again a massive change. Let me tell you, there's almost a temptation to take names, but I will avoid that. But a lot of big names in Pune changed their practices. And what did that mean? Obviously a cash flow, obviously a taxation issue. So this is to tell you that PF applies on eligible components, not only on basic pay, or not only on basic salary, as is the perception. Okay, so these were the principles that the Supreme Court ruling reinforced. Again, there was a technical question. Did the Supreme Court ruling of March 2019 lay down new law? Well, we don't think so. Though, industry like to believe it is new law, so there should not be any implications for non-compliance in the past period. But no, what we believe is that the Supreme Court has merely clarified the law that was already laid down in some earlier Supreme Court rulings. Okay, so in our day-to-day practice, it's always a good idea to check on PF practices of our clients' companies. You never know, there might be serious non-compliances with respect to the amount on which PF is contributed. So it's worthwhile to know as professionals. Now, moving on again, the moment. Can we go to the previous slide, Anmol? Yeah. So, as you would note, how is PF taxed? Before we get into that, what is PF? Well, 12% of monthly pay. Okay, employer-employee. There are some nitty-gritties, but largely it's that way. Allocation, if you're a new member, that is after September 14, well, and if your monthly pay is more than 15,000, everything goes to PF. If it is less than 15,000, a part of the salary or the employer's contribution goes to the pension scheme. So the pension scheme has not been abolished. It's just that, the government realized that they are sitting on a massive time bomb, when it comes to pension payouts. So what they did is they brought this clever amendment to say that if you are a member of PF, if you're contributing to PF prior to 1st September, well, you can continue to have a portion of your contribution go into the pension scheme, where you will get a pension after a certain age. And if you're a new member into PF, you will not get any pension. So this is broadly, how the PF contribution looks like. Of course, the employee can contribute more, but the employer is under no obligation as per PF law to contribute, to more than 12%. If monthly pay is more than 15,000, both employee and employer can agree to restrict the monthly pay on 15,000. Okay, so after 15,000, PF is optional. You may choose not to contribute, or you may choose to contribute and restrict it to 15,000. Below 15,000, PF is mandatory. Okay, so that's just a very brief idea of the PF scheme. Now we'll move on to the next slide, where very quickly we all know that contribution up to 12% of monthly pay is fine. Okay, when the employer contributes, and that comes from Schedule 4 of the Income Tax Act. Now, Finance Act 2020 is introduced, you could say, a draconian provision in terms of the compliance burden by saying that any contribution above 7.5 lakhs made to 3 funds, and we'll talk about that later, will be taxed. So we'll talk about that. We have a separate section for that. Yeah. Now, employees' contribution. Okay, employees' contribution. What is said is, and again, before that, we have a query about the pension scheme. So what we are saying is, maybe we can just go to the slide or earlier slide, Anmo. Yeah. So there's a question on pension scheme. So if you see on the right-hand side, okay, if monthly pay exceeds 15,000, and if the person has become a member of PF after 1st of September 14, then the entire employer's contribution goes to Provident Fund. If the monthly pay is below 15,000, then of course a part goes to pension fund. Whereas if the person was a member prior to 1st of September 14, then mandatorily 8.33% of the employer's contribution used to go to the pension scheme. So that is the change up. Okay. So I'll just allow, So let's move on. As you can see on your screen, we talked about employer's contribution. Employees' contribution, again, whatever is contributed is eligible for deduction under 80C, nothing great. Interest on employers and employees' contribution, again, that is not taxable, assuming the interest pay rate or the payout is as per the rate fixed by the government. Again, needless to add, Finance Act 2021 has brought in an amendment, to tax any interest on contributions that exceed 2.5 lakhs, and what is that we will see later. Okay, so let's move on to the next slide. Yeah, and at the time of withdrawal, what happens? Well, very in a summary form, if the period of continuous service is 5 years or more, then nothing is taxable. If the period of service is less than 5 years, then that is where taxation kicks in. So if somebody renders a service of 4 years and withdraws his PF, then indeed the person will be taxable. If he has rendered continuous service for more than 5 years, then there will be no income tax. Now, it is important to know that continuous service includes service with the previous employer. So it is agnostic. It doesn't matter which employer you have rendered services with. And then, of course, some procedural provisions pertaining to transfer from one PF to another. Yeah. Now, what happens if, let's say, somebody withdraws his PF before 5 years of continuous service? How does taxation pan out? Well, employer's contribution is taxable under the head salaries. Employee contribution, mind you, is not taxable, and there has been a Supreme Court ruling in the past in the case of Grand Hyatt, where it is nothing but return of the person's own money. So how can you tax that? So that is not taxable. Interest on employees' contribution, again taxable as salaries. Interest on employees' contribution is taxable as income from other sources. So that's very briefly. Now, at the start, I did make a mention about how PF, is there really a controversy? Now, I remember my studentship days, and whenever we used to refer to the Vinod Singhania's Reckner, invariably there used to be this ruling: gestationer duplicators. Okay, salary includes commission. So that's what was fixed. So really, what is that controversy? That was in the context of section 36(1) and deductibility of PF contribution. But there is one aspect that we would like to draw your attention to, and that's what you see on the slide. A controversy which has always existed right since the year 1961. Okay, but surprisingly, this has never been picked up, and we hope this is not picked up. And what is that controversy? So I will directly invite your attention to the table that you see on your screen. As you can see, on your screen, let's say if the salary of a given individual is the way you see on the screen, then what is the contribution the person needs to make to PF? Okay, so we saw very quickly, of course, that all eligible salary components need to be included for the purpose of PF. So if you have basic salary and special allowance, then the question is, what is the contribution on PF that should be done on 22,000? So of course, the employer has the choice to restrict the PF on a base of 15, but assuming that the employer says no, employee says no, we want to contribute on eligible components, then PF will apply on 22,000. But now here is what the problem is. We have Schedule 4. Now, as per the definition part of Schedule 4, what we find that salary has been defined. Okay, so when we say 12% of salary is not taxable, so where the employer contributes 12% into PF, and when we say it is not taxable, then what is 12% to be computed on? Well, it is salary as per the definition given in Schedule 4, which paradoxically says that salary includes dearness allowance but excludes all other allowances. Okay, so if we look at the numbers, then special allowance is something that does not fall in the definition which is given in the in Schedule 4. So in this case, salary as per the tax law, income tax law, will be 12,000, whereas the employer is contributing 12% on 22,000 because that is as per the PF law. So the question which arises is that is the difference in the employer's contribution on 22,000 minus 12,000, is that salary income, and is this taxable in the hands of the employee? And are there corporate tax implications for the employer? Well, the most important part is, surprisingly, and I can say the best part is that the department has never picked this up. Yes, there was gestational duplicators, which in the context of the deductibility of PF contribution says, no, if there is commission, you need to include that as a part of salary. But the point is that when it comes to the test, which is there in the in Schedule 4, because the allowability is more linked to the PF law, to say that as per PF law, you are mandated to contribute on 22. Okay, whereas income tax says 12. So is there a tax risk? Now we try to go back. Okay, PF law came in the year 1952. Income Tax Act came in 1961. So was there any rationale in Schedule 4 as to why they should have given this definition in a restricted manner, or a restricted definition really? Well, there was no rationale. We really did not see anything to suggest that this was intentional. So one may argue that this is not intentional, and the entire construct of a recognized Provident Fund, whereby you have to go and get CIT approval, and you have to have restrictive clauses in Schedule 4 which says that you cannot give terms that are less favorable than the Provident Fund law, and all that supports the view that there needs to be a harmonization of these two laws. Okay, one cannot read both the laws in isolation, and there is a strong case to argue that the error or the difference is unintentional, and therefore the definition as per Schedule 4 should be aligned to the definition as per the PF law, and therefore there should be no perquisite, okay, in the hands of the employee, or any implication for the employer. So this is an interpretation part. So the point here is that something which we have all been taking as a given, that if the employer contributes 12%, then it is automatically exempt. Well, that does not seem to be the case, and let us hope that this is not picked up, or before it is picked up, there is a suitable amendment made in Schedule 4 so that there is harmony between the two provisions. And I don't know. I mean, I'll be happy if somebody shares if they have seen any litigation on this. But to our mind, we have not seen any litigation on this front. Okay, so just thought of leaving you with this thought on this anomaly, which has persisted now right since the year 1961. Okay, now another point on PF which we would like to discuss, and again something which is commonly omitted, is that non-taxation after completion of 5 years is only up to the period that the person terminates his employment. So let's say if somebody terminates his employment after 10 years in year 10, but he does not withdraw the PF and he withdraws after 12 years. So for 2 years, the amount is lying with the department, with the EPFO say, and earning interest. So the question is, are we saying that the entire amount of interest up to year 12 is not taxable? Well, that's not the case. Okay. What is not taxable is only the accumulation up to the date of retirement or end of the employment, which is till year 10. From year 10 till year 12, 100% the interest will be taxable. And that's something we have seen most employees tend to ignore, and especially when they get a refund, and leading to unnecessary challenges both from the central processing unit as well as at the assessment stage. So this is again a message we wanted to leave you with. Yeah, so let's move on. Now, whereas we've seen just a snapshot of PF, and as I said, we are going to cover the amendments made by Finance Act 20 and 21 separately. But before that, we thought it fit to quickly take you through what is approved superannuation fund. Again, those of us who are familiar would know that for PF, you have a PF law of 1952. For superannuation, there is really no law. What comes out are certain, provisions as per Schedule 4 again. And what is the objective of a superannuation fund? Basically to provide an annuity. Now, what is the limit? Again, 15%. Okay, so up to 15%. And again, the definition of salary is the same as per the PF, as per Schedule 4, to the extent it applies to PF, which is salary is basic plus DA, but excludes everything else. Okay, then Rule 87 comes into play, where the employer can contribute. If the employer is contributing 12% towards PF, then he can contribute a maximum of 15% towards superannuation fund. Okay, so a total of 27% can be done. And again, the amendment of made by Finance Act 2020, we'll come to that. Basically, maybe around 10 years ago, superannuation was commonly, or quite common, in the sense that it provided a good corpus that used to get built up for an employee. But with the emergence of NPS, okay, National Pension Scheme, the focus on superannuation has reduced, and in fact, even the government is encouraging, transfer from a superannuation fund into NPS, and that is, there is a provision introduced in Section 10 which says that this transfer is non-taxable. So this is very broadly on superannuation in terms of the construct. There is no legislation as such. What comes out is certain conditions given in Schedule 4. If those are met, approval is granted. And if the employer contributes, then a tax kicks in only if the combined contribution of PF, NPS, and the superannuation fund exceeds 7.5 lakhs, which we will see later. And withdrawal, where surprisingly, if you withdraw, it is only if you withdraw something on the date of superannuation do you get the benefit of Section 10(13). Otherwise, sorry, if you get a lump sum withdrawal, it is taxable. Okay, so that's very briefly on superannuation. Let's move on. Yeah. Now NPS again, if we talk of NPS, earlier it was only for central government employees. Now provisions have been introduced for private sector as well, and it's turning out to be a very popular measure. Yeah, Anmol, can we go to the next slide? Yeah. So as we see here on NPS, it is regulated by the PFRDA law, the Pension Fund Regulatory Law that was brought in. So you have a separate law on that. Then there are provisions for contribution. Tier 1 account is a mandatory account. Tier 2, let's not even talk about that for the moment. Tier 1 is where contributions are made. You can have a individual contribution scheme. The individual himself can contribute, or you can have a corporate scheme whereby the company also contributes. Okay, and we are all aware about the returns, and there is enough advertisement in the newspapers and in terms of the yield that is announced by NPS fund managers on a year-on-year basis. It seems to be quite lucrative. So the whole concept of NPS is, okay, you're exempt at the stage of contribution, exempt at the stage of accumulation, but there could be a tax that kicks in at the stage of withdrawal. I'm saying could be because of the way Section 10 exemption is worded, and we'll just come to that in a moment. So let's move on. Yeah. Now, contributions, you can have unequal contributions. So there's no, bar on how much you can contribute. Unlike PF, there is no upper limit to how much you can contribute to NPS. Okay, if you have the appetite for locking your funds up, then it's a good option. Now, what is the deduction? Now, when we talk of NPS from an income tax perspective, typically 80 CCD1 comes to mind. That if an employee contributes, then up to 10% of his salary, that's where he gets a deduction. Okay. Now that's the thought that comes to mind. That deduction can be up to 1,50,000, and you can also get a additional deduction of 50,000. So if the employee contributes 2 lakhs, it is deductible. But the most important benefit of NPS that we are seeing comes not so much from the employee's own contribution, but rather from the employer's contribution. Okay. And that is where the real play lies. And if you go through focus your attention on the lower part of the slide, what you find is that employer's contribution to NPS is treated as income under Section 17(1)(8), but there is a deduction under 80 CCD2. Of course, the new section 17, which has brought this 7.5 lakhs taxation. We will talk about that in a moment, 17(2)(7). But ignoring that, this is where the largest tax benefit comes in. So imagine a situation where, let's say, and we are in the era of high salaries being earned by a lot of individuals. So what you find is employer's contribution can be a very large chunk, and that the person becomes eligible to treat that as non-taxable. So imagine if let's say basic salary is 25 lakhs annually, can happen, and say 10% of that the employer contributes. So straight away 2.5 lakhs becomes non-taxable, and that's a massive advantage. Okay. Employer, in the hands of the employer, it's obviously a deductible expenditure under Section 36(1). Yeah, move on and move. Yes. Now, withdrawal, again, we don't want to get into the nitty-gritties, except to say that withdrawal has its own challenges. Up to if you have been a member for 10 years, that's the least that you need to be in order to be eligible to withdraw. If your corpus is less than 250, you can withdraw entirely. If not, 80% goes for pension. On the other hand, if you withdraw on attaining the age of 60 or the superannuation age, then if your corpus is less than 5 lakhs, you can withdraw entirely. Otherwise, maximum withdrawal is 60%, and 40% goes into pension. And thanks to the income tax amendment which has been made under, that is Section 12A, so Section 10(12)(a), which says that any withdrawal up to 60% is not taxable. So imagine, the person's corpus is say ₹100 at the time of, let's say, withdrawal, and he's attained the age of 60 or superannuation. Then out of that, 40 rupees he will have to mandatorily transfer to purchasing an annuity. What remains is 60, and thanks to section 1012A, which says 60% is not taxable, effectively there will be no tax in the hands of the person at this particular stage, which is receipt of that entire accumulation, where 40 rupees goes to purchasing the pension plan, and 60 rupees is what he gets in hand. So, over the years, this has been, relaxed. Earlier, the limit was a little lower, and it was 40%, and on 20% of the contribution, a tax used to kick in, but no longer. Okay. Then there are whatever is received as pension from the NPS will, of course, be taxable. Then it was felt that partial withdrawal should be allowed. So recently a provision has been brought in to allow partial withdrawal, okay, from the NPS scheme, and a corresponding amendment has been made by way of section 1012B, whereby the employee is eligible to withdraw 5% of his own contributions, and that is to be treated as not taxable. Okay. Tier 2 account, it's really not material. Tier 1 is the material account. So that was very quickly on NPS. Then what happens to gratuity? Again, you have the payment of Gratuity Act, which is important. What the payment of Gratuity Act, again, very important to note that once the new labor laws come into play, payment of Gratuity Act will vanish. Okay. So it will be subsumed into the Code on Social Security, which is the new labor law, which has been passed by Parliament, and all that is awaited is the date from which the law will become effective. And again, our colleague Pratik will take us through those provisions on labor law. But as of now, the payment of Gratuity Act applies. Okay. So as soon as the government notifies the new labor codes, the payment of Gratuity Act will cease to exist. And again, what is gratuity? We again regulated by Schedule 4. The employer typically has to pay gratuity if a period of service is 5 years. So that is the mandate. An employer can give better terms. Okay. So there is a limit of 20 lakhs, which is there in the Gratuity Act, and therefore that is the exemption limit which is available in under Section 10 as well. Can an employer pay more than 20 lakhs of gratuity? Yes. So 20 lakhs is as per the gratuity law, but there is a provision in the Payment of Gratuity Act which says that an employer can indeed pay more gratuity on better terms. And in our interactions with a lot of multinationals and other Indian headquartered companies, a lot of companies have better terms when it comes to gratuity. So instead of giving 15 days salary for each completed year of services, which is basically half-month salary, many companies say, no, we'll give you 1 month salary for each completed year of service. Okay. So to that extent, the companies are giving better terms. And can a company give better terms of gratuity? The answer is yes, as per the Payment of Gratuity law. That is 100% permissible. Only thing is that if the total quantum is more than 20 lakhs, then the income tax exemption will be restricted to 20 lakhs. So that's the whole thing. And clearly, when it comes to Social Security, this is a very important provision, because this is probably the first of the items, one could say, where the employee is not really contributing anything. Okay, like NPS, unlike PF, which is his own money that is coming up back to him in one or more ways, depending on restrictions, age, period of service, etc. In the Payment of Gratuity law, you can say that this is one of the Social Security items. And the whole intention is that this should serve as a retirement kitty for an individual, right? Individual really does not contribute. It is the company is obligated to pay to the employee if he has completed 5 years of continuous service. Okay. So with that, let's move on. Yeah. Now, The objective of all this was just to give a overview of how taxation pans out, and what are the laws in force today which govern some of the key items of social security. Now we go over to the amendments which have been made by Finance Act 20 and Finance Act 21. Now, before we even talk about those, okay. As soon as the current government in its first term came to power, the late finance minister, Mr. Arun Jaitley, okay, somehow there has been an affinity towards taxation of individuals. This government has, you can say, gone hammer and tongs after the individuals. We've seen that in the form of hike of the personal tax rate, right? We've seen that. At that time, provision was brought in to tax Provident Fund. It was like blasphemy. I mean, how can you bring in a provision to tax Provident Fund when historically for decades together, that was a very important source of not only savings but tax benefits for individuals. That was the provision that was introduced, but then it never saw the light of day. It was scrapped after a lot of protests. Okay. So that was the first of the attempts made by the government to get in some easy money, which is to tax the salaried class. Okay, that's like a soft target. Then if you see, very quietly they slipped in one more amendment, which is to restrict the deduction on account of the house property loss only to 2 lakhs in a year. Now, all those living in Mumbai or the metros will vouch for it that, interest of maybe 10 and 15 lakhs on self-occupied property was being paid by these individuals because the property prices ran into crores. But what happened earlier, everything was being offset against salary and therefore providing a massive tax benefit. But now only to the extent of 2 lakhs is deductible. So again, and this amendment came in very quietly. It impacted a lot of the so-called high net worth individuals, but there were no protests because this class is not the one that's going to go and protest. There were no protests, and finally the amendment sailed through, and now we've all accepted that. And now, as if that was not enough, now you have this amendment made by Finance Act 2020, which says that employers' contributions towards EPF, NPS, that is Provident Fund, NPS, and Superannuation Fund in excess of 7.5 lakhs will be treated as taxable in the hands of the employee and triggering a withholding tax requirement for the employer. Okay. Then Section 17(2)(7)(a) says any interest on such excess contribution, now I'll be referring to the word excess contribution, will be treated as taxable. Okay, so this is what the law says, and so let's if we talk of who might be affected by this provision. Now, if we look at the last 15 years, okay, if you look at corporate India in the last 15 years, clearly, salaries, whatever they were, say 20 years ago or 15 years ago, are no longer the same. For the last 15 years, salaries have grown exponentially. So, a salary of 75 lakhs, 1 crore, more than a crore is not that uncommon as it was 15, 20 years ago. And people have also realized the importance of Provident Fund as a tool of savings and earning tax-free interest. So considering that, there are a lot of people who may be in the 1 crore bracket and let's say with a basic salary. So typically in India, basic salary ranges between 30% to 50% of the total cost to the company. So if on a salary of 1 crore, if basic is 30 lakhs, then you can imagine, 12% of that, okay, which is 3,60,000, that's the employer's contribution to PF. If the person also has a superannuation scheme in operation, if the employer has, then you have a further 15% being contributed to superannuation. And I don't know whether I mentioned this, but the cap of 27% does not apply to NPS. So an employer is free to contribute, to Provident Fund up to 12%, to a superannuation fund with up to 15%, and totaling to 27%. But NPS and is over and above that cap. So the 10% of employer's contribution to NPS also can be made. So if this you can say high salaried individual is contributing to everything, then you will find that the total employer's contribution is indeed going more than 7.5 lakhs, triggering this tax. Okay, so while this amendment came in March 2020, what happened is COVID struck, and the computation mechanism was not notified. In fact, it got notified in March of 21. Okay, so this is the section. We have an illustration also, but then before we go to that, what the government realized is the story is just half complete. I mean, they are trying to tax the employer's contribution to the extent it exceeds 7.5 lakhs. But what about the employee's own contribution? Obviously, you cannot tax any contribution made by the employee, because that contribution itself is his contribution he's making out of post-tax salary. How can you tax that? So they brought in this amendment by Finance Act 21, which seeks to tax employer's contribution or employee's own contribution to PF, okay, above 2.5 lakhs, and only the interest portion of it. Now, the whole drafting scheme has been done. I mean, I don't want to use the word shoddily, but really that's how it is, because all they have done is to, bring in the amendment in section 10. Okay, rather in section 10.11 and section 10.12, which says that when the person withdraws, to the extent of this excess contribution, there will be a tax on the interest part. There is no change. Yeah. So there is a question: interest on employee contribution more than 2.5 lakhs. Who should deduct? So it's not the employer really; it's the PF trustee's headache. Okay. So it could be the EPFO, or it could be the private PF trust. Now, as I was mentioning, and I hope that answers. So, the point to note here is that taxation will kick in at the stage of withdrawal. Okay. So the language used in section 10.11 as well as section 10.12 seems to suggest that what is sought to be taxed is the excess, or rather the interest on the excess amount over 2.5 lakhs. However, at what stage will it be taxable? Obviously, at the stage of withdrawal, because these exemption sections talk about granting an exemption at the stage of withdrawal of the accumulated balance. Okay, so clearly that you can say it's almost a saving grace. And again, mind you, in the next slide, we'll just take you through some of the numericals about how this looks like. And then we will talk of some of the controversies, because clearly the number of controversies that these two sections have brought about are far more than the benefits in terms of tax revenue. The headache for employees, for employers, for employees, for PF trusts, for the EPFO as well. Yeah. So I think this is, to answer Sunil's question, this has not been specified in the Act, in the sense that at what stage this will be taxed is not specified, except that section 10.12 and section 10.11 talk of granting an exemption at the stage of withdrawal. And the amendments have been introduced by way of provisos to these two sections to say that if you satisfy the requirements of this section, then to that extent the interest will be, the exemption will not be granted to this interest part. Okay. So to that extent, there is no charging section, or there is no section which is levying the tax. Rather, what they are saying is, at the stage of grant of exemption, you will not get this exemption. So it's that way. Okay, so let's move on, Anmol. Yeah, now the slide has scrolled. Now again, if we just step back, when it comes to this taxation, so this is Finance Act 2020. We are in the month of March of 2020. The section came into existence. However, the rule as to how one computes, computes benefit was not known. Okay, so the question is there any benefit, right? Now the question is, this rule got notified in March of 21. Somewhere in the month of March of 21 is when the rule got notified. And again, we will not go through what is mentioned. When I first read the rule, I thought it's very complicated. Okay, but it's not that way. There is a formula, and to interpret in a simplistic manner, what the formula basically says is that anything which is over and above 7.5 lakhs. So let's say, for the purpose of our discussion, let's talk about financial year 2021 as the first year, and 21-22, which is the current year, as year 2. Okay, so in year 1, which is 2021, if there is any contribution which is more than 7.5 lakhs, then to that extent there will be a tax trigger. Any interest, okay, that the fund may have got, and again there is a debate as to at what stage is that interest taxable. Okay, and we'll cover that in a moment. So that is also Anmol, can we go to the previous slide, please? Yeah. So the interest also will be taxable. That is in year 1, and in year 2, what will happen is this particular excess amount in year 1 and the excess interest amount also in year 1, that again will be subjected to tax in year 2, in addition to the excess contribution of year 2. Okay, so that's a simplistic way of looking at things. Year 1, the contribution to the extent more than 7.5 lakhs, then interest to the extent of interest on the excess contribution, that is taxable in year 1. In year 2, whatever was the excess of year 1, that will again suffer tax. When I mean excess, I mean interest part of it, the perquisite part of it. Principal amount will again earn interest, that will be taxable in year 2, in addition to the contributions of year 2 itself. Right? So just move on to the next slide now. Yeah, so this is just an illustration to see how the tax impact kicks in. So if we see on the left hand side, you have financial year 2021, and what we can see here is that if the opening balance to PF is 50 lakhs, right now we are restricting ourselves only to PF because there is a controversy around NPS and superannuation, and we'll cover that. And let's say employer's contribution is 12 lakhs. So 12 lakhs plus 7.5 lakhs, 4,50,000. Okay, that is the taxable perquisite under 1727. Interest on that, assuming interest is paid out in the same year, okay, will also be taxable. Now in year 2, now let's go to year 2, assuming that the contribution remains the same. Again, there will be a fresh contribution of 4.5 lakhs, which is 12 lakhs minus 7.5 lakhs, which will suffer taxation. Okay. At the same time, the amounts which suffer taxation in let's say year 1, which is 4,50,000 plus interest thereon, again we'll have to contribute interest on that. Okay, and subject both the tranches to taxation. So in the first year, you had a piddly sum of 17,000, which I'm sure a person in that salary bracket would have been happy to pay. And in year 2, however, the taxable perquisite increases. And the worst part is that as the years pass, and as you have a greater and greater amount which exceeds 7.5 lakhs kicking in, then the perquisite value will, or rather the perquisite value and the taxable and the tax on that will keep on increasing in perpetuity till the amount is withdrawn. So I've just tried to simplify again. I'm sorry I'm not able to give the audience too much time to go through this because we have a lot to cover, but just thought of mentioning this. Now, more importantly and interestingly, what is important is to see what are the implications now. Let's go over to the controversies in the next slide. Okay. Now, the biggest point which has not been addressed is that if let's take an example where 5 lakhs is the contribution made by the employer to PF. And let's say, hypothetically speaking, 5 lakhs is the contribution made to NPS. So 10 lakhs is certainly exceeding 7.5 lakhs. But whether the excess should be attributable to PF or should it be attributable to NPS? Unfortunately, the law and the rule does not clarify this. Okay. Now, the next question might be, why is this important? Why should we understand from which fund this is coming through? The reason why this is important is that what is taxable is the excess contribution and the annual accretion. So the section uses the terminology of annual accretion, okay, which again is not defined in section 12, but in schedule 4, when it comes to PF contribution, annual accretion has been defined as, in relation to PF, it is the balance to the credit of an employee, okay, arising from contributions and interest. Okay, so that is what annual accretion means. I mean, I remember, just to step back, somewhere in March of 21, when this rule came about, Rule 3B, a lot of employers were discussing, look, should we consider interest on PF contribution that has been made for financial year 2021 as a part of perquisite or not? Again, we are talking of a case where the contribution exceeds 7.5 lakhs. So that was the debate being done, because there was a view being expressed that, look, the EPFO or the government has already notified the interest rate in the month of November itself, which will apply for financial year 2021. Then why can't we create an accrual? But there is a good case for the employer to argue that the word annual accretion has been defined, and what it simply means is balance to the credit of an employee, which means that mere notification of the rate of interest by the PF authority will not help. What matters is that the interest should be credited into the account of the employee. Only then the perquisite tax, to that extent it pertains to interest, will kick in. Okay. So a lot of employers said, okay, but we don't want a disallowance. We'll estimate interest on an estimated basis and compute that. So that is also something that we have seen from a salary tax withholding perspective. But what we believe is, if we look at financial year 2021, what is taxable in financial year 2021 is only the excess contribution, because interest is credited by the PF authorities right now in financial year 21-22. So it is in 21-22 that interest will be taxable, and not in financial year 2021. Now to again come back to the controversy. Why is it important to understand as to whether that excess is out of NPS or PF? Because under NPS, there is no accretion in the strict sense of the word, because all those of us who are familiar with NPS, what happens is, at the end of a given period, there is a net asset value which is derived, and your corpus is valued accordingly. Okay, so there is a notional gain. There is no accretion in the sense that it is defined. There is no addition to the account of the employee. So if I am an NPS subscriber, what I know is what my corpus stands today. Is that the same money I will get? Probably yes, but there is a chance the corpus may reduce if the fund does not do well, and therefore I may incur a loss as well. So really, does this section even apply to NPS or to a superannuation fund? That is a big debate. And financial year 2021 was the first year. Now this being the second year, this is when this controversy will be examined by employers. And what we believe is, there is a good case to argue that this section cannot be used to trigger or cannot be said to apply to contributions made to NPS, because there is no accretion to the balance, okay, to the account of the employee. All that you get is merely a corpus which is valued at a given date. Okay. Then another point is the way they have and again, if we say accretion to NPS is sustainable, then there should be a provision for decrease in valuation. There should be some deduction that is available, but that is not given. That is again rather a sad aspect in the drafting. Now coming back, let's look at the way contribution to NPS. Under section 17(1)(8), employer's contribution to NPS is treated as income, and then a deduction is available under section 80 CCD2. Okay. But what you find is that under section 1727, you might have a situation where excess NPS contribution is again added. So in your gross total income, at the stage of gross total income, you have a double addition. First under 1718 and then again under 1727. Is that sustainable? Can we say this is double jeopardy? I know practically after you get a deduction of 80 CCD2, this may not matter. But really at the stage of computation itself, is this something that is sustainable, can be challenged by employers in the years to come. Okay. Now, one more controversy is that there's a note to the formula given in Rule 3B. So let's take in year one, which is financial year 2021. Let's say that's the first year the employee contributes, and the contribution made by the employer is 10 lakhs. And let's say it is only to PF. So 2.5 lakhs, that is 10 lakhs minus 7.5 lakhs, will suffer taxation, right? So far, so good. Now, let's say in year two, out of this opening balance of 10 lakhs, let's say he withdraws 5 lakh rupees for whatever purpose. So the opening balance is 5 lakhs. Now, the problem here is that in the next year, there is no scope to argue that the withdrawal has been made out of that portion, which is the excess above 7.5 lakhs. That is what this note rules out, which means even in the next year, though the opening balance has, or at least the balance has reduced from 10 lakhs to 5 lakhs, what the government is saying, no. In year one, your excess was 2.5 lakhs. Now in that remaining 5 lakhs also, this excess of 2.5 lakhs will exist, which means you have a situation where the government wants to tax you in perpetuity once you are taxed, unless you exit and withdraw the balance entirely. So does it mean that the government is going back on its promise? Probably yes. Then last two bullets are probably even worse, which is the double taxation. Okay, so let's say we have a high salaried person who is now suffering tax under 1727 and 1727A. If he withdraws his money from, if he retires or resigns before 5 years and withdraws his money, then he is going to end up suffering a tax, okay? Because the exemption under section 1012 will not be available, okay? So what you find is that the employer contribution would have been taxed twice. Once under 1727 at the stage of contribution, and then at the stage of withdrawal, because the exemption under section 12 is not available. And that's clearly ridiculous, the way the scheme has been worded. Now, similarly, if let's say instead of PF, there's a contribution to approved superannuation fund, even then, while there is a exemption available under 1013, that is available in a very, very limited manner. Okay, so here also, what will happen is you will find the employer's contribution being taxed under 1727. And at the stage of withdrawal, if the exemption condition is not satisfied, you will find that a tax will kick in again under section 1013. So clearly it's one thing to tax something and going back on your promise of, not taxing a social security or a beneficial provision, but it is another matter if certain categories of employees are going to be taxed again on the same income. Clearly ridiculous, but that's what we see. Okay, so let's move on. Yeah, now there are some issues also that come in from an employer tax withholding perspective, and that is important because most of our clients will be companies and employers. So really, what should an employer do? Okay, so you have section 1727, you have the annual CBDT salary TDS circular, which is issued from time to time. And what you find is there's no guidance on what the employer's obligation is. So let me give an example. Okay, when it comes to the, let's say, a deduction on account of self-occupied house property, what happens is every year the employer notifies a certain form. Okay, and the employee fills that form. He gives the details. Employer collects some proof, and tax deduction is, or at least the loss is considered when it comes to salary withholding. But here, are we saying employer now needs to maintain records on a year-to-year basis. Okay, because let's say when it comes to employer's contribution to PF, that is something the employer can be argued to know about, right? How much is the employee's contribution? The employer knows. So let's say if in year one, somebody has suffered taxation under 1727, employer knows that he's contributed 10 lakhs, so 2.5 lakhs is extra. So in the next, are we saying that the employer per force needs to say that okay, 2.5 was the perquisite amount, so that was the opening balance of perquisite. And if we just deviate, in the past, various high courts have laid down an employer's obligations to say that an employer is expected to exercise due care and caution. Wherever the legislature wanted that proof should be taken or details should be given, they've introduced the amendment. So you would recall section subsection 2D was introduced in section 192, by which again form 12BB was introduced, whereby again the employee has to mandatorily give details. So if there is nothing prescribed, then what is expected is due care and caution. Various high courts have laid down the employer's responsibility from a salary withholding perspective. So here, given that the employer knows that he's contributed an X amount to PF, it does seem as if the employer's burden is going to increase, because now year on year, the employer has to maintain the record. Okay, in year one, what was the excess, carry forward that excess, even if the employee does not declare anything. Okay, so to that extent, what we would say is this is probably the first of the provisions when it comes to employee salary tax withholding, where memorandum records will have to be maintained by an employer on a year-on-year basis. There is no escaping that. Okay, at the most, an employer may argue that, let's say, if contribution to PF is made to the EPFO, Employees Provident Fund organization, then the employer can ask the employee to report the amount of interest. The employer can argue that, look, I am under no obligation to investigate if the right interest has been received or not. But at least when it comes to contributions, there is no escaping, which means doing the computation and carrying that computation forward and continuing to maintain these records. Okay, and that's clearly a very unfortunate development from an employer tax withholding perspective. Again, we talked about the controversy of how to allocate to PF, to NPS, to a approved superannuation fund. Now, when the employer is doing the TDS, who has to take the decision about this allocation? Again, should the employer stick his neck out and take a decision? So here again, there will be some heartburn, because the employer will have to educate the employee and try and leave it to the employee to take a call and position that the employee wants to take. If the employee wants to contest that there is no accretion within the scheme of 1727, and therefore this section can be held or should be interpreted as not applicable to NPS and ASF, well, that's your call. You give me in writing that this was your intention and I will proceed accordingly. So clearly, there are challenges from an employer tax withholding perspective, and the first year has gone. The department will take a liberal view. But financial year 21-22 is where a lot of companies will now need to take a relook. Now, you may argue, well, how do you really, there are not enough employees to whom this section will kick in. But I'm sure the very big corporate houses of India will have many employees, where this tax might trigger, and therefore the employer's headache in terms of documentation will increase. Okay, so let's move on to the next question. Next slide, Anmol. Anmol, can we move to the next slide?
Yes, Jagdeep.
Yeah. Somehow the slide has not scrolled. At least it's not scrolled for me.
I think there's some lag. Just give me 1 minute.
Yeah, sure. Yeah. So while my colleague Anmol, takes us to the next slide. Now it has scrolled. So clearly, when it comes to that provision of employees' contributions exceeding 2.5 lakhs, just from a completeness perspective, this also applies to contributions made to Public Provident Fund. Okay, PPF, we all contribute, but fortunately, there the limitation is 1.5 lakhs by the PPF law itself. So really, you are well within this limitation. You may argue, what if I contribute to the PPF account of my spouse? Well, that will not be hit by this section because the language is very clear in the account of the person. So spousal contributions made by you or anyone else's contribution of say minors will not be hit by this. Okay. Then the question is, how will the EPFO keep a track? So just imagine somebody, let's say this provision which is now there continues to be in operation say for the next 10 years. Okay. Then and let's say every year this employee contributes to more than 2.5 lakhs, and he was an employee for let's say 5 preceding years as well, so total of 15 years. Now how will the EPFO keep a track and compute what is the interest arising on contributions to the extent they exceed 2.5 lakhs? It is going to be a nightmare for the EPFO. I mean, just imagine the infrastructure that they will need to have, because today, the EPFO is taking the easy way out. Okay, so we said that if somebody withdraws after 5 years, then nothing is taxable. So does it mean that the EPFO is not deducting tax under 192A at 10%? No, they are taking the easy route out. They are deducting 10% and saying, you fight it out in your income tax return, you fight it out with the CPC, which is more than happy to raise a demand. Okay, that when TDS has been made by the EPFO, why are you treating this as non-taxable? So how will the EPFO keep a track? Similarly, when it comes to the recognized PF trust, the private PF trust, clearly the headache increases to increase this. Yeah, and one finally, we are sure that the valuation mechanism for this particular provision has not yet been introduced. The section says that this provision will be introduced. So it is fair to say that if the valuation mechanism does not come through, or the computation mechanism does not come through, one may argue that the section really fails. But again, just like section 17(2)(7, they brought in the rule 3B somewhere in March of 21. One may expect that in the next few months, this particular rule will be notified. So these were some of the controversies, and I'm saying some. Actually, it defies logic as to why these provisions were brought in the first place. If you look at the sum total of the revenue, the tax revenue that the government collects, what might be the incremental revenue on account of these provisions? That really might not be too much. Yes, it will pinch somebody at an individual level, but not at the level of the government's overall tax revenue. But at the same time, for basically a very small gain, there is a huge onus on the EPFO as well as employers as well as private PF trusts. So that is basically what these changes are. And at a much higher level, can we say the government is going back on its promise of whatever exemptions that were committed to encourage social security? That's also a fair argument. Okay, so with that, let's move on. Yeah, so now what's the discussion within industry? Next slide. What we've seen is a lot of employees in conjunction with their employers are saying, look, I was contributing to PF on a salary of say 50 or whatever. Let's say if my basic salary is 30 lakhs, I'm contributing on that. Yes, I'm earning handsomely in terms of non-taxable interest. Now it is taxable because of this provision. So now can I go back and restrict PF on a base of 15,000, which I'm eligible to as per the PF law? Okay. Now we have this experience of income tax that if your advance tax reduces, or your self-assessment tax or your total tax reduces, you get a query from the TDS wing saying, why have you deposited less? So in similar way, the PF authority might also come back. They might not even agree, but that's technically possible. And this is something that a lot of companies are discussing as an approach which will help the employer as well as the employee. Okay. Similarly, if you see on the right-hand side, can basic salary itself be reduced? Okay, so you compensate the individual with a special allowance or something else, don't contribute PF on that, and reduce basic salary, so that on an overall basis you come within the 7.5 lakhs limit. So this again is a core labor law issue. I can say that yes, one can look at the possibility of doing this. We have not seen any section which says that this cannot be done. Okay, as long as this is done not unilaterally, but the employer and employee together doing this, we believe that this is something that can be done and can be explored. So these are a couple of thoughts which most, or not most, a lot of companies are actually considering over the last 6 months or so. So as to enable the employees to get out of that 7.5 lakhs taxation. Of course, there is a flip side, which is that the employee's savings will also reduce, because what he gets in hand will be an increased special allowance, which again will be taxable. So there is a trade-off. On one hand, savings will reduce, perquisite tax on account of 1727 will reduce, but on the other hand, what you find is the overall tax burden may increase. So there is a trade-off, and there's no perfect solution. It is each employee along with his employer who will have to decide. Now, yeah, so Anmol, let's go ahead. Yeah, so there is a lag. Yeah, I can see the screen now. As you can see, very recently, again, a couple of procedural points only, we won't even go through all. We saw in the last month or so that employees were unable to upload their Provident Fund ECR return. Okay, so that's also something that they were not able to do because, and that's point number 2, because the UN and Aadhaar linking was not done. So fortunately, there's been an extension granted, but I can confirm that a lot of companies have been late in depositing of the PF, because the system was hanging, and this extension came in at the last minute, and this could create implications from a corporate tax deductibility perspective. Now, if you see point 1, again, to enable people to withdraw money in COVID times, what you find is that the government has allowed employees to withdraw from their PF. Okay. Now, again, there is the controversy here, is the amount of withdrawal taxable in the hands of the employees? So this is what we call as a COVID advance, a one-time ability to withdraw money from your balance, which is there with the EPFO or the private pre-PF trust, and you can withdraw up to 75% or 3 months of basic and DA, whichever is lower. Again, there is no provision which clarifies whether it is taxable or not. If the withdrawal is made out of the employee's own contributions, one may argue it's not taxable. Otherwise, a tax may kick in. Though, the authority publicity material, this is not taxable, but there is no corresponding amendment in the income tax law. Okay, so there is something we need to be mindful of. Yeah, Anmol, let's move on. Yeah, now we come to again international workers, which is something a little new for all of us. So we have roughly half an hour to go, and there are 2 sections here. One is international workers, and second is labor codes. Again, labor codes is a vast area, and we'll try and cover a little bit of those. So international worker, who is an international worker? So this is a provision that came in the PF law. Okay. So prior to 2008, October of 2008, PF applied to, PF did not apply to somebody who is a foreign passport holder. Okay. But somewhere from that time onwards, if one has seen the way in India's industry and employment situation has panned out, there has been a huge influx of expatriates being deputed to India, that is foreign nationals. Similarly, there have been a lot of, let's say, Indians who have gone abroad. Okay. So who is an international worker? International worker is for an inbound, that is somebody who's working with an Indian company. It in simple terms means that he's somebody who is holding a non-Indian passport. He may be a OCI card holder, but if he has a foreign passport, he's an international worker. For an outbound employee, okay, who is an Indian. If he, then the definition is a little complex. It means that he's somebody who has gone to a country with which India has a social security agreement. And what are the countries with whom India has a social security agreement? We'll just come to that. Okay, so broadly, this is the distinction. And what is the impact of that distinction? Let's go down. Okay. Uh, yeah, so next slide. While the slide scrolls, why has this provision been brought in? Because if you see, most of Indians used to go to US and UK, where they are subjected to huge social security contributions. Okay. Now, as a retaliatory measure, okay, this provision was brought in to impose social security on international workers, right? So again, without getting into too many details, you can see the contributions. But the important point is that this 15,000 cap, which is available for PF contributions for domestic employees, is not applicable to international workers. So let's say there is a foreigner, say a German who has been deputed to a auto major company in Pune. Okay, now he's an employee of the auto major Indian subsidiary. Let's say his compensation is 1 crore rupees annually. Okay, and let's say he has only two components, basic salary and special allowance. Now the question is, on what does PF mandatorily apply? So PF mandatorily applies on the entire 1 crore. So that 15,000 limit will not help. So this is a massive cost to the employer to contribute 12%, for the employee to contribute 12% on such a massively high salary base. Of course, there are ways and means to mitigate that. So let's move over to the next slide, Anmol. Yeah. Again, withdrawal is largely the same. No, go back. Yeah. So, are there any mitigation measures to ensure that the PF contribution can be limited? Yes, there are. And what are those? We'll see that. But can an international worker basically withdraw his money? The answer is yes. Initially, there were a lot of restrictions in the year 2010, 11, 12, where money, was stuck very badly for a lot of multinationals. In fact, when we had our discussions with a lot of clients, what we saw is that, most foreign companies used to consider this non-refundable amount as a massive cost that will sit in their books. And therefore, they used to, to consider that while talking of a deputation to India. That is how big the problem was. Because if you see the first bullet, withdrawal on retirement, that is 58 years of age. So withdrawal was permitted only till 58. So imagine a foreigner who comes and works with an auto major subsidiary in India at the age of 25. He works for say 3 years and he goes back. Now he's contributed a lot of money, but he cannot withdraw till the age of 58. And that was ridiculous because he would go back, he would lose touch with India, etc., etc. So all those things were kind of happening. So then what they brought in a provision whereby if there is a social security treaty between India and that particular country, then withdrawal is possible. So that was a welcome relief. So there are two parts. Does India have a treaty, social security treaty with the US and UK? The answer is no. So the trigger was a retaliatory measure against the treatment given to Indians in the US and UK. But unfortunately, unfortunately, what has happened is that really, when it comes to these two countries, there is no relief. So somebody coming from US or UK has to mandatorily contribute to Indian Provident Fund, right? Withdrawal possible if covered under the social security treatment. So let's say we talk about this 25-year-old German. India has a social security treaty with this person. So if he contributes to PF, he can withdraw upon end of his assignment. If this 25-year-old person is a US national, sorry, you will have to contribute to PF at massively high amounts. Even section 17(2)(7) may also kick in, but the withdrawal will be allowed only till the age of 58. Okay, so that's what we see. Yeah, next slide. Yeah, now maybe what we can do, Anmol, let's go over to the social security agreement slide, and let's come back to this issue slide. Okay, so social security agreement. Let's go to the slide where there is the umbrella. Yeah. So very broadly, what is this concept? So this concept is that India, just like our income tax treaties, India has social security treaties. So you see in the order, Belgium right down to Portugal. What it says is, in certain conditions, a person coming to India from Belgium, Germany, Switzerland, etc., if he gets a certificate from that social security authority, then he need not contribute to PF in India. Similarly, if an Indian goes to these countries and our EPFO issues that certificate, then he need not contribute to social security in those countries. And trust me, for a change, while this involves extensive discussions with the EPFO, all this is happening very well. Our Indian EPFO grants the certificate seamlessly. Contributions need not be made in these massively costly overseas countries. And likewise, those, when these people come to India with their certificates, the Indian government is honoring this provision right away. So without any hitch, that's the best part. But most critically, as you can see, and as I mentioned, US and UK is not covered. So somebody coming into India from the US and UK will have to contribute to PF, and simultaneously somebody going to US, if we are in the IT space, we will know that the largest outbound Indian population is to the US. And what happens? They end up paying huge social security in the US, and mind you, that is all sunk cost. Because barring one or two cases where they are eligible to withdraw, if it's a scheme that is similar to our PF, otherwise it's all sunk cost. Had there been a treaty, then Indian outbounds would not have contributed, and the employer would have saved a massive amount of money. So yeah, that is what it is. Okay. So now we talked about this certificate of coverage. Is that certificate of coverage must be obtained to avoid this contribution, provided there is a social security treaty between India and that country. And we saw the list of countries with whom India has a treaty. This system, fortunately, is working very well as per at least our experience. Okay. Now, Anmol, let's go back to the that particular slide where we had those issues. Yeah, go back. Yeah, hold on there. Now, issues around international workers. Now, as I told you before we turn to labor codes, is that a lot of employers were not compliant when it comes to PF. And unlike domestic employees where there is a 15,000 cap available, there are various other arguments to explore as to why you can get away with some non-compliance. Here the problem is very big, and especially after the Vivekananda Vidya Mandir ruling of March of 2019, a lot of companies realize that they are not compliant. They have not contributed to PF even for past. And I can tell you a very interesting situation. We were in one of our clients who is an IT company with 10,000 employees. What they found is that let's say from the year 2010 till the year 2020, some 80 odd people of with US passports had worked for this particular company and had gone back to the US. PF was done only on 15,000 rupees. And they were drawing, say, 1 crore plus salaries. PF should have been contributed on aggregate salary. And why was this non-compliance? Because nobody bothered to check their nationality. They looked Indians, they were of Indian origin. So it was assumed that they are, Indian passport holders, whereas they were US passport holders. So this company went back. They spoke to the PF authority, said, we have not done the right thing. We want to remediate and make good the contribution. And accordingly, they went back. Okay. And they actually ensured that they made past period contributions as well. So I'm just giving you this example. Trust me, a lot of companies realize that they are non-compliant. And that is how the Indian PF office has got a lot of money over the last few years, because companies want to make sure that they are compliant with the Indian PF law. Okay, and since then a lot of companies have made it mandatory that at the time of recruitment, please submit a copy of your passport, because we don't want to take the risk. You look an Indian, you are an Indian, but for all we know, you may be a US passport holder, liable to PF on aggregate salary. Okay, so this is a major controversy that we have seen, in the recent past, and which I would say that a lot of employers are now cognizant and they are doing the right thing. However, a lot of non-compliance also persists in this particular space. Okay, so let's move on now. Yeah. Yeah, now move on. Yeah, I think, of course, we'll take those questions towards the end. I can see some questions have popped out. Just interest. Yeah, now we have a section, a shortish section on labor codes. Okay, now what is the new labor codes? How are they going to impact? What are the changes? I mean, this has been the discussion of the last 8 to 9 months. And it has caught the attention of, all senior folks in industry, employees, everyone dealing with this particular, aspect. Okay. So the point of argument is this. So Sachin, to answer that question, I think I just saw some detachment certificate and certificate of coverage is really one and the same. It's not that there is something which is different. Then labor codes. So I will request my colleague Pratik, CA Pratik, to just take us through what these changes are and what they mean for industry at large. So with that, I will request Pratik to please come in.
Thank you, Jagdeep. We now move towards the last leg of this session, and as Jagdeep explained, we will now go through the labor code's impact on social security. Before we proceed to understand the impact of labor codes on social security, let us spend a couple of minutes so as to understand the background and the nature of labor codes. As you can see over your screen, there are 4 codes that have been prescribed by the government: the Code on Wages, Code on Social Security, the Occupational Safety, Health and Working Conditions Code, and the Industrial Relations Code. In sum total, these 4 codes shall subsume existing 29 labor-related laws. The current status of all the 4 codes is they have been passed by both the Houses of Parliament, approved by the President, and also notified in the official gazette. So what remains is only the entry into force. That is, the implementation date is something which is yet to be awaited. The 4 labor codes were notified much before November 2020. The current status is draft rules were also notified. It is only draft rules which were notified in November 2020, and a timeline of 45 days was prescribed by the government to gather industry comments on these draft rules. After the timeline closed, we are yet to get back from the government on the final rules on all these 4 labor codes. The government was keen to implement these codes in April 21, but with the delay on the part of states to finalize the state rules, coupled with the second wave of COVID, the implementation has now been deferred. A recent news article, which is as latest as 2 or 3 days before, suggests that the new Labour Minister has also begun the process to review the draft comments that were shared with the ministry, and they are in the process of consultation with industry bodies and trade unions in order to understand what amendments are required around these labor codes. Lastly, only a handful states have notified all the 4 draft rules under the respective state laws as well. And it is a buzz across the industry that the other states will also notify the draft state rules under all the 4 labor codes. The implementation of these codes may be in a one go, or it may be in a phased manner as well. A perfect example around this, maybe we can say, Jagdeep explained us about the ECR mapping in order to have the Aadhaar linking with the employers. So this comes from the Code on Social Security, wherein the relevant section is already in force. So it may so happen that the labor codes may be implemented in a phased manner as well. In the next slides, I happen to mention that there are 29 existing labor laws which are being subsumed. Some of the key laws which will be subsumed here include payment of minimum wages act, payment of wages act, the bonus act, employees provident fund act, gratuity act, maternity benefit act, then the factories act, industrial disputes act are also some of the major laws which are being subsumed here with the implementation of the labor codes. While the labor codes in itself requires a separate 2-hour session, here, as you can see over the slide, we have captured some of the key focus areas which we believe are necessary to understand the impact of the labor codes as a whole. In the subsequent slides, we will go through the impact of labor codes on social security, but this is a general overview of what are the key focus areas pursuant to the labor codes coming into force. You all may be aware, one of the key objectives of the labor codes is to simplify and avoid the multiplicity of the existing laws. So in view of this, the new labor codes have consolidated the existing multiple definition of wages, which is around 12 different definitions, and this has now been consolidated into one single definition. With this single definition coming into force, certainly this will have a major impact on the existing compensation structure of the employees. And as an employer, every organization would now need to review the impact of this. The second point or focus area is around the specific rules that have been notified under the labor codes, which include what is the normal working day of an employee, what are the provisions of rest day. It suggests that every employee must be provided with a rest day during a week. Also, there are certain rules around eligibility of overtime. The overtime needs to be paid at twice the normal rates. So based on these provisions, the employer will now need to ensure that their existing HR policies and processes, whether they are in line with the labor codes. And if not, one needs to gear up so as to ensure the sync with the codes. The labor codes provide for, on the previous slide, the labor codes provide for a maximum ceiling of 50% deduction from the wages. So by deduction, we mean the government has prescribed deductions include income tax as well as PF. So it proceeds to say that only maximum 50% of deductions are permissible from the wages of an employee. In view of this, definitely employer needs to ensure that the deductions does not exceed these wages. Then there are certain timelines which have been prescribed around payment of wages. In case of monthly salary, yes, the salary needs to be paid before 7th of the succeeding month. However, one interesting amendment here under the labor codes is the full and final settlement of an employee needs to be made within 2 working days from the last day of the employee. Yes, I'll repeat, it is just 2 working days from the last day the employee has rendered service to the organization. Certainly, from practical perspective, yes, the industry or the employer would need to carry out F&F settlements, would need to recover the assets, would need to adjust the loans and advances, which typically takes 15 or 30 days, is something which is an industry-wide practice. But with the codes as it stands today, it is only 2 working days, and hence employer needs to gear up the process around these payment of wages once the codes are effective. The fourth focus area is review of third-party contracts, which is nothing but the contractor-related agreements. One of the existing law, which is Contract Labor Regulation and Abolition Act, is also being subsumed. So with this, the employer needs to ensure that the impact of codes on the contractual workforce is also taken due care of. ERP system changes, yes, the labor codes prescribe for a uniformity across the industry with a prescribed format of wages, pay slips, appointment letter, and all relevant employee related matters. So in order to ensure that every employer has the uniformity across all these letters, one needs to ensure that proper ERP changes are taken care of. Lastly, there is a need to develop a robust governance so as to ensure end-to-end compliance of the labor codes framework. These were the key focus areas. Having gathered the background, the current status, and the key focus areas, we will now move towards the next slide where we'll understand the impact of labor codes on PF, ESIC, and gratuity. The first of the impact is from Provident Fund perspective. Currently, the Social Security Code as it stands today, it says the contribution towards PF are required to be made at the rate of 10%. Yes, it is 10%, but a notification is yet to be issued by the central government so as to increase this rate to 12%. A similar notification stands issued today as well, which is under the existing Employees Provident Fund Act. We believe that in all possibility, yes, the rates of contribution, which is 12% each by the employer as well as the employee, will continue to remain same under the Code on Social Security. Important change under the labor codes is point number 2. The PF contributions will now be required to be made on the new definition of wages. We discussed the definition is now one common definition. Earlier, Jagdeep took us through the definition of monthly pay. What are the challenges around this definition? The adjudication by the Apex Court in Surya Roshni ruling. All these amendments were applicable or which were more on the monthly pay definition, which stands today under the EPF Act. But under the labor codes, we have this new definition of wages and all compliances. The PF contribution is now linked to this definition of wages. The monthly pay will no longer be applicable under the labor codes. One common theme under the labor codes is all contributions, say PF, ESIC, gratuity, and other payment of wages is now linked to this single definition of wages. Point number 3 is a benefit for the industry where we can say that yes, there is a relaxation which suggests that the existing PF and pension schemes will continue for a period of 1 year from the date the codes come into force. Jagdeep happened to take us through this amendment wherein he mentioned us that the ceiling limit of 15,000 is something which is applied presently due to the current provisions of EPFO. So given that the proviso to para 26A, which helps the employer to restrict PF contributions on 15,000 or to contribute only on basic salary is something, this option is also available under the labor codes pursuant to this relaxation of PF scheme being carried forward for a period of 1 year. Now, let us understand the impact of labor codes from ESIC perspective. The existing ESI law has now been subsumed under the code under the Code on Social Security. And similar to the PF scheme, yes, the ESIC scheme has also been retained for a period of 1 year from the code coming into force. Point number 2 is that the ESIC Act, which stands today, largely the same provisions have also been retained under the labor codes as well. And the good part is the applicability of ESI provisions continues to remain same, which is the existing limit of rupees 21,000. One change, yes, the limit of 21,000. Earlier, we used to comply with this limit of 21,000 based on the definition that was prescribed under the ESIC Act. But now under the labor codes, it is only one common definition of wages, where as an employer, one needs to ensure or comply whether the provisions of ESIC are applicable to a particular category of employee. The rates of ESIC contributions continue to remain same. That is, the employer will contribute 3.75% and the employee will contribute 0.75%. But yes, this contribution is linked to wages, not the existing definition of monthly pay. Largely, no major change under the ESIC Act. We now move forward to the last impact area, which is we can say a major impact from gratuity perspective. Under the existing provisions of Payment of Gratuity Act, the gratuity benefit is payable or computed on basic salary and the DNS allowance. But with the existing Payment of Gratuity Act being subsumed and the gratuity payouts under the new code being required to be made on the basis of new definition of wages, certainly yes, there is going to be a huge impact on the gratuity payout that one needs to pay. Basis the law as it stands today, the labor code suggests that the computation of payment of gratuity is to be made retrospectively. That is, on the definition of wages since the day the employee has joined the organization and till the date of retirement, due to which this may lead to a surge in the cost to company. And being a major area of concern, industry-wide representations have been made to the ministry in order to either grandfather or relax some of these provisions around the payment of gratuity. But yes, till date, there has been no clarification or notification from the government around this grandfathering of payment of gratuity. Point number 2 is we have come across certain, during our interaction, many of our clients have come up with this point that there is a notion that employee is now eligible to gratuity if he renders service of more than 1 year. No, this is not the case. The existing eligibility of rendering minimum 5 years of continuous service has been retained under the labor codes as well. However, a new class called as fixed term employee is now also covered under the Code of Social Security, which will now be eligible for gratuity. Now, one may have a query, what is this fixed term employee? So let us take an example. If Mr. X is hired by a particular company for a period of 1.5 years, the employment letter indicates the specific duration. So given the fact that this employee is hired for a specific duration of 1.5 years, which is more than prescribed period of 1 year, he will now be eligible for payment of gratuity. So to summarize, the typical existing employment contracts, we do not have any end date. Either the employer or the employee can resign and serve the notice period and he can leave the employment. But somebody who is hired for a fixed duration, and if the duration exceeds 1 year, then yes, this is the impact area for company. The employee, being a fixed term employee, will now be eligible to payment of gratuity. Point number 3, last point, where the current limit of rupees 20 lakhs is prescribed under the Payment of Gratuity Act. This has not been laid down under the Code on Social Security or the corresponding rules thereto. Hence, given the fact that these ceiling limits are yet to be notified, and in case of any change in the limit, the employer will need to revisit the impact on its policies and processes. There is a link between the Payment of Gratuity Act and the Income Tax as well. The Payment of Gratuity Act being subsumed under the codes, now the income tax authorities would need to appropriately amend the corresponding provisions of Income Tax Act, which is the section 10(10)(2) of the Act. With this amendment, this will align the tax exemption with the labor codes. So with this, we have captured the labor codes impact from the Social Security perspective. With this, we now keep the floor open for any doubts for not just labor codes, but the entire session that we have. We'll be happy to address them.
Yeah, thanks, Prateek. This is Jagdeep here. Just a couple of points would like to make on the labor codes for the audience. Is that, look, when it comes to social security, in the strict sense of the word, we saw what is the impact, and clearly gratuity is an area of massive concern, and hopefully the government will grandfather those provisions. Otherwise, all companies, be they MNCs, India HQ companies, companies, they are really worried about potential gratuity liabilities going across the roof. So there's been a lot of discussion, should the actuarial valuation be changed? Should there be a provision in the book? Should there be a note to the accounts? So hopefully the government will address this and ensure that the impact is smoothened out with the introduction of grandfathering provisions on gratuity. On PF also, just would like to just make one point here, that if you look at 17(2)(7, okay, it says that if you make excess contributions, you will be taxed. On the other hand, under the labor code regime, the potential for a bigger contribution to PF exists because the definition of wages is different. So in that sense, yes, there is a lot of alignment that is required for when it comes to the introduction of the labor codes, and let us hope that the whole process is made really smooth by the government. So in the interest of time, let me just turn to the questions, Sachin, if that's okay. And let me start from the last question, which says many employers make it compulsory for employees to opt for PF even if wages are more than 15,000. So what will you suggest to do if the employee doesn't want to? Look, PF is optional, okay? PF is optional if monthly pay is more than 15,000. Yes, you are right. Most employers make it mandatory. The only recourse you have is, look, if it's the company policy, I don't think you will have much of an option, or you will have to go by that at a practical level. I don't think practically there will be an option to not contribute. Yeah, but you can certainly discuss with the employer, hey, how about contributing only on 15,000? I don't want to contribute on basic because my basic is very high. Okay. Yeah, and also many organizations deduct both employees and employers' contribution from employee salary. Look, that's a matter of presenting. There should be no scope to deduct employees' contribution, but yes, employers' contribution is typically shown as a cost, which is part of the cost to the company. So I don't think there is a challenge there. It is merely a matter of representation. Then detachment certificate and certificate of coverage, largely the same. Then PF withdrawal, I think my colleague Pratik has answered that. In how you can withdraw. 89 relief, yes, but quantum can be debatable because when it comes to PF taxation below 5 years, you have to go and look at the tax applicable in that respective year. So practically how much relief it will yield is doubtful. Then interest on employee contribution more than 2.5 lakhs, who should deduct TDS? We said, it's not the employer's headache per se. It is the trustees of the EPFO, or the EPFO, or in the case of private trusts, the trust itself. Okay, and of course, taxability at the stage of withdrawal. Then we answered that question on the pension scheme after 2014. Sachin, so that's where we stand, and Mehul, if there are any further questions. So I guess there's one more question. Whether social security will be deducted in UK in the absence of SSA? When will he get it back? When he leaves country or at the age of 58? So let's say if there is an outbound employee to the UK, let's say from India he goes to the UK, you are right, UK social security will be deducted for the simple reason that there is no treaty between India and UK. Okay, so indeed UK will apply their social security law, and when it comes to withdrawal, let me tell you that in these developed countries, Europe or US, social security is of two parts. In India, as I keep on saying, it is PF, it is your money that comes back. In the developed countries, your money coming back is a very small portion. The other portion is what they call as insurance, which will be a major sunk cost. So yes, you will get back, but you will not get everything. It will be a very small amount that will come back to you.